You can tell a person from the heroes they worship. I worship Mr. Timothy Dexter, an eccentric entrepreneur of the 17th century. He made bets that had no logic, but they turned out to be gifts of providence. For example, he was tricked into sending coal to Newcastle. Newcastle in England was the womb of coal. It was a move of the demented, but miners in Newcastle went on a flash strike. Coal prices shot up and Dexter made a turn. His business rivals suggested sending bed warming pans, a winter tool, to tropical West Indies. His ship captain sold them as molasses ladles. Dexter made out again. My Dexter movement came in the spring of 1991 at the foothills of the Harshad Mehta boom. I spied an opportunity in a company called Karnataka Ball Bearings. The company did not seem to be having a great market for its ball bearing or whatever it is that it made, hence, it was making massive losses. Then one fine day it announced it was closing down. A shifty trader settled up to me in the trading links of the BSE and whispered, "Buy KPB." I asked why. It is a sure thing. When it was operating, it was making huge losses. But now that it has closed down, the losses will shrink. Heck, it might even turn profitable. And by the way, I have some stocks I can sell you. I was a callow youth. My inner Dexter was seduced by the transient logic. It was God's own stock. Of course, it was a setup. I bought at rupees 5. Clearly, that low IQ bull market thought the same, and the stock went up to 150 or something. My moderately better IQ had me sell. I had my first fortune. You can be right for the wrong reasons and yet get rich. Mastering this is a rare skill. I have since always believed that great fortunes are often the result of good fortune. The reason I mentioned this little story is this: can we call the Harshad bull market an actual bull market? Or a pseudo bull market funded by public sector banks into a handful of stocks? A market that was played by a bunch of insiders and Dexters like me. Nah, it was just a teeny rigged wave. Dr. Manmohan Singh was denied credit. That would come later. Then we had a barren patch right until the end of the decade, and then started the tech boom. It lasted all of 1.5 years. This is clearly seen in Exhibit 1. The earnings bars for the 1996-2000 tell a story. They are flat to declining. Corporate India was hurting real bad. Only one sector blew lights out, that was tech. Again, it was an incestuous bunch of players who backstabbed each other all day on the trading screen and backslapped at Joffrey's all night that made all the money. It met almost no test of a good bull market, depth, breadth, or durability. The inspiration for this piece came from the most cerebral sell-side economist in India, Mr. Dhananjay Sinha, who said to me, India has had just 2 periods of profit growth, and he shared the data the next day. Onwards into memory lane, the bull market one that started in May 2003 seemed different. It was coming out of 11 years of zero returns. It met all the tests. It was broad and inclusive. Large and small caps all did fabulously, and it was durable. Clearly, it can be seen in Exhibit 2. Our first real bull market delivered 50% on the Nifty 50 and 76.5% on the BSE small cap CAGR in rupee terms between 2003 and 8. But believe it or not, it delivered even more in dollar terms as the rupee strengthened from 47 to 39 in the same period. This was also an emerging market bull market, but India did better than most. 9% GDP growth at 1% fiscal deficit, with no long-term capital gains tax created lower about some investors that endures till today. But as I always say, there are no great investors. There are only great bull markets. That era was the real deal. Dr. Manmohan Singh would not be denied. And then our stock market engine idled for almost a decade till COVID. And that's when our second bull market in 36 years started. I met some tests but flunked a few. For example, one of the key tests I apply to judge the quality of a bull market is something I call time shift return dispersion. It simply means that a true bull market should not require you to get your timing down to needle point precision. So the question becomes, suppose you entered that bull market 1 month before or 1 month after the absolute bottom, what would your returns be compared with those of somebody who got the absolute bottom right? Exhibit 3 clearly shows and answers that. The 3 to 7 bull market return dispersion in Exhibit 3 is minimal. It did not really matter when you entered. 1 month before the bottom you made 48.9%, whereas 1 month after the bottom you made 47.8%. Our 20 to 24 bull market falls this test. In Exhibit 3 we can see it. Entry 1 month before the March 23 bottom, you made only 18.3%, much less than the bottom catcher who made 32%. But now we come to the lower intestine of this bull market analysis. As Exhibit 1 shows, there was indeed a sharp growth in the Nifty earnings per share EPS from financial year 22 onwards. However, some things are important to need in KNED. We had a corporate tax cut in financial year 2020 that had approximately a 20% positive impact down the road on EPS. But there is a bigger accounting chimera that happened in financial year 22. The Nifty EPS has started reporting consolidated earnings. Before that, they were standalone. Exhibit 1 shows you the difference. The change in EPS accounting increased Nifty EPS growth by around 40 to 45%. The consolidation reduced through a spectral simmer, the PE of the market. Of course, we also saw a post-COVID bump in government capex via fiscal deficits that remained very high for years after COVID, and the fiscal deficit is winding down, leading to a flattening of the capex. Exhibit 4 shows how a reality eventually wins over surreality. S-U-R-R-E-L-I-T. Why? Even as EPS was growing, sales growth wasn't tangoing. Even as EPS was growing, sales growth wasn't tangoing. Ultimately, what matters is not so much earnings, but revenue growth, and that started drifting down, as Exhibit 4 shows. Vivek called in his eye-opening piece in News Laundry the case of the missing rupees 80 lakh crore who shrunk India's consumption economy. Is the question. Helpfully filled up the other blank, the one of consumption size, as it turns out by the government's own revised GDP numbers. With the new base year of 22-23, our consumption has been lower by a tad below $1 trillion over 4 years. You read this right. Bull markets are often based on fiction, fantasy, fairy tales, but bear markets are always based on facts, figures, and fundamentals. Our second bull market is not Ben Johnson, but it certainly has Maradona's infamous hand of God. One final concerning fact, as Exhibit 2 shows, is that the aggregate returns between bull market 1 and 2 have reduced sharply. In bull market 1, we got 50% CAGR from large cap and 76% CAGR from small caps. In bull market 2, the same index return have declined 36% to 32% from large caps and 50% from small caps. Our bull market returns plans has shifted disturbingly down. The next bull market, whenever that happens, will probably deliver even lower aggregate returns. A larger base, negligible innovation, and easing companies depending largely on domestic markets will contribute to this, unless something changes. Measured over the last 10 to 12 years, the Nifty has delivered only around pre-tax 10% in dollar terms. It halts despite region GDP growth. It's around 0.5% despite reasonable GDP growth. Foreign institutional investors, FIIs, with their uncased capital see these data. If this is what India promises and exits are plentiful because of systematic investment plan flows, it would be foolish not to take money off the table. Capital gains tax is only a pimple. The lack of long-term return is the tumor. Returns is the tumor. So here is it. Here it is. The Indian stock market mythos of 36 years is wrapped in a diaphanous negligee, lashed together by a delicate etheric sash of 1.6 bull markets. To make money from here on will require a ground invasion, trench by trench, rather than carpet bombing, way more difficult. Indian investors should probably switch their gods from Buffett to Dexter.